Hi, my name's Josh, and unless you've been living under a rock, you've heard that the banks are failing. Why is this happening, and what should you do about it? Before I talk about the bank that caused this current crisis, you need to understand this. Banks use a system called fractional reserve banking, and this basically means that whenever you make a deposit, the bank only needs to hold on to 10% of it, and the banks can then invest or loan out the rest. For example, if a bank had $500 million in assets, it must hold $50 million in reserve for when customers want to make a withdrawal. This is where that concept gets kind of wild though. Let's say that I'm a bank and you give me $1,000. I can then go and loan $900 of those dollars out to another bank, and they can loan out $810 to another bank, who can then loan out $729 to somebody else. Fractional reserve banking allows customers access to a much larger pool of money, and the banks get to earn interest on those deposits. The goal of the banks is to receive enough deposits from people to cover withdrawals from everyone else. Banks typically incentivize customers to leave their money in their accounts with these high interest savings rates, and they don't count on everyone making withdrawals at the same time. This allows the fractional banking concept to continue working. However, when too many people try and take out their money at the same time, this can create liquidity issues at the bank, or more simply put, the bank runs out of cash reserves that they can give back to their customers. This means that banks would have to close their positions early on bonds that they purchased with your money in order to cover all of those withdrawal requests. This also means that the banks would lose money due to early termination fees or from selling bonds to someone else but for a lower price. You've probably heard of Silicon Valley Bank by now, and if you haven't, this is probably where the 2023 bank collapse started. The bank was founded in 1982 and primarily focused its lending to tech startup companies in Silicon Valley, and it was one of the go-to banks in this area for the last few decades. In 2020, during the COVID crash/pandemic, interest rates were lowered to 0%, which resulted in large increase of issued loans. And then in between 2021 and 2022, SVB invested roughly $90 million into government-backed bonds, which tied up the money for 3 years. These bonds gave them a 1.79 interest rate, which is really small, but it's better than collecting zero. Silicon Valley Bank took a bet that the Federal Reserve wasn't going to raise interest rates as fast or as high as it did, which then put them into a very difficult position when they ended up being wrong. Here's an example why. Let's say that I'm Silicon Valley Bank and I purchased $1,000 worth of a 4-year bond at a 2-year interest rate. As long as I could leave that money in the bond and let it mature, I'd have $1,082.40 at the end of those 4 years. What happens though if interest rates rapidly rise right after I bought the bonds, just like they did in 2022 for SVB? If interest rates rose to 7%, that same $1,000 investment would have been worth $1,310, or a $228 difference for the same amount of time. This isn't a big deal if I were to hold on to the money for the full 4 years. It would only mean that I'd lose out on bigger gains. But what if I had to sell that bond because I didn't have enough money on hand to give you back your deposit? In that case, I'd have to pay $228 just to sell the bond to someone else to give you your money. This is basically what's happening to Silicon Valley Bank, with so many people trying to withdraw their money at the same time. It's crashing the bank and it's making them lose a lot of money that everyone else deposited. This then leads more people to becoming worried that they won't be able to get their money back, so then they go and withdraw their money out of the bank, which makes the bank crash even faster. Here's a recap of the domino effects that led up to the bank failure. First, SVB tied up too much of their money at the wrong time and for too low of a return because they were wrong about the Fed raising rates. Second, most of their clients are tech startups which require lots of cash and/or withdrawals to cover their expenses. And third, as liquidity dried up at SVB, customers were not able to withdraw their money. This then led to the bank selling off bonds at a loss just to cover those withdrawals. This then led to customer panic, which led to everyone trying to rush in, get their money out before the bank completely failed. So to prevent the collapse, on March 8th, 2023, Silicon Valley Bank decided to sell off 1/3 of its company as stocks to raise money to pay back their customers. The next day, March 9th, news of the bank's liquidity issues made news, and SVB's stock plummeted by 60%. On March 10th, after failing to raise enough capital from the stock shares, SVB announced that they were looking to sell the company. Shortly after this, the bank was shut down by regulators and the FDIC took it over. Yeah, it's the same FDIC that insures deposits up to $250,000. So why couldn't SVB customers just chill out and file a claim? Well, it's because 97% of the deposits were over that amount and they were not insured. Those companies would have likely gone out of business if they were left with only that amount. So if you're like me, and you don't have $250,000 saved up, you might be thinking, how does this even affect me? Well, it's true that if you're not banking with SVB, you don't have anything to worry about from that specific bank collapsing. However, it's not the only bank that this is happening to. There are other banks such as Silvergate, Credit Suisse, and Signature Bank that are facing similar challenges. It seems like the entire banking system is starting to collapse. However, just understand that these banks are involved in a very niche tech startup industry where lots of money was going out and little money was coming in. And this is all at the same time that a large portion of their money was tied up into upside-down assets. I think that most people in the US don't have to worry about losing the money that they have in their checking or savings accounts. Most banks are not faced with these specific problems, and most people don't have $250,000 inside of their accounts. If you're still concerned about the banks failing and the rate that inflation is eating away at your buying power, there are a few things that you can do. First, you can make sure that you keep less than $250,000 inside of a single bank account. Second, you can invest into precious metals such as gold and silver, and if you're interested in that, there's a link in the description for Noble Gold Investments. Or third, you can invest your money into safer dividend-paying stocks to combat inflation. If you like this video, then subscribe and share it with your friends who are freaking out about the bank run crisis. And then go watch this video next to learn how much money you need to save up in order to retire.